Welcome to Learning Unit 1 Introduction to Accounting. Before we calculate anything, before we balance a single equation, we have to agree on the environment that the business actually operates in. That is what this unit does. Accounting is the language of business, and this learning unit teaches you the alphabet. The subtitle on the screen calls this the roots of the financial tree. And I want you to hold on to that image for the next half hour. Roots are not glamorous. Nobody photographs them. But everything visible above the ground, the trial balance, the income statement, the statement of financial position you will build in later units, draws its structure from what happens down here. By the end of this session, you will be able to do five things. You'll be able to define accounting as a process rather than as arithmetic. You'll be able to define who uses accounting information and why their needs differ. You'll be able to explain what makes that information useful and what makes it useless. You will also be able to distinguish the four business forms found in South Africa and the consequences of choosing one over another. And you will be able to place any organization into a type of business activity and match it to the branch of accounting that serves it. Three times during this session, I will stop and put a question to you directly. When that happens, pause the recording and answer it in writing before you carry on. Those questions are not preparation. They are how you find out whether you have understood the section you have just heard or merely recognized it. Let us begin with the definition. The first thing to unlearn is that accounting is about crunching numbers. Numbers are the raw material, they are not the point. Look at the statement on the screen. Accounting is a dynamic communication system that reacts to the external environment. Every word there is a load bearing. So let us take them one at a time. Communication. Accounting exists to move information from the people who hold it to the people who need it. If nobody receives the message, no accounting has taken place, no matter how neat the ledgers are. Dynamic and reactive. Accounting is not fixed set of rules carved in stone. It changes as the world it describes changes. Think of what has happened in the hospitality industry alone over the past 2 decades. Online travel agencies, dynamic room pricing, digital wallets, and card not present payments, load shedding pushing energy costs into the operating budget, pandemic that emptied hotels overnight. Every one of those changed what businesses needed to measure and report. Accounting followed. Financial and non financial information. This is the point students most often miss in assessment. Accounting is not restricted to rand and cents. Occupancy percentage, average length of stay, staff turnover, servers served per shift, energy consumed per room night, guest satisfaction scores. All of these are accounting information because they inform the same decisions. The financial numbers tell you what happened. The non financial numbers usually tell you why. And finally, informed decisions. That is the purpose of the whole exercise. Every step we discuss today exists so that somebody, an owner, a lender, a duty manager, a revenue authority, can make a better decision than they would have made without the information. There is one more consequence of being reactive that is worth naming. Because the environment changes, the rules change too. Accounting standards are revised, tax legislation is amended, and reporting requirements are added. This is why the qualified accountant never stopped studying, and why the textbook is a starting point rather than a final authority. Hold that definition in mind. The next slide breaks it into five working parts. Here is accounting as a system in five steps: gathering, analyzing, recording, reporting, interpreting. Learn them in that order because the order is the logic. Step one is gathering. This means bringing together all the financial information that affect a specific business. Notice the word all. In a hotel, that means guest folios, restaurant and bar dockets, bankering contract, supplier invoices, payroll records, bank statement, till slips from the curio shop. If a source document never reaches the accounting function, the transaction it represents effectively did not happen as far as the records are concerned. Step two is analyzing. Now we determine exactly how that information affects the business. This is where judgment enters. Supplier invoice for fresh produce affects your cost of sales, and it affects what you owe your creditor. A 10% rise in food prices affects restaurant profitability, menu pricing, and possibly the decision to change supplier. Analysis is asking, what does this actually mean for us? Step three is recording. Inputting the information through proper accounting processes, journals, and ledgers. This is the mechanical stage, the one people picture when they hear the word counting, and it is the one stage a computer does better than a human. In later learning unit, you will do it by hand. Not because you will do it by hand in practice, but because you cannot supervise or interrogate a system you do not understand. Step four is reporting, summarizing all that information for a given period into a condensed and readable format. Monthly departmental income statement for rooms, for food and beverage, for conferencing. Annual financial statement compression is the whole value year. Thousands of transactions become one page and a human being can actually read. Step five is interpreting, analyzing those summarized reports so that decisions can be made. Why did the beverage gross profit percentage fall 4 points this quarter? Should we open on Monday? Can we afford the new laundry equipment? Which brings me to your first checkpoint. Suppose a business gathers its data perfectly and records it flawlessly, but never reports it and never interpret it. Has the accounting system succeeded? Pause the recording here and write your answer with a reason drawn from the definition we covered a moment ago. I will not answer it for you, but I will give you the hinge. Reread the phrase to help users make informed decisions. Financial information is worthless if nobody consumes it. So, who consumes it? We divide users by their position relative to the boundary of the organization. Inside that perimeter, internal users. Outside it, external users. Same business, same underlying data, very different questions. Let's start inside. Owners want to know one thing above all. Is this business profitable? And is it viable over the long term? Am I earning a return on what I've put in? Or should I put in more? Managers need operating detail. Which department is underperforming? Is the kitchen holding its food cost percentage? Are we running efficiently? Managers receive information that is more frequent, more granular, and more forward looking than anything an outsider ever sees. Employees have a stake as well, and students routinely forget this one. Employees want to know whether their employer can continue to provide stable employment and pay salaries. That is exactly why financial information becomes relevant in wage negotiations and in restructuring discussions. Now, step outside the boundary. Customers, including corporate clients and tour operators, want assurance that the business will still be there to supply what they have booked. Nobody blocks 20 rooms for a conference with an establishment that may close before the date. Competitors read your published information to maintain their competitive edge. That is a legitimate use of public data, and it is one reason companies disclose only what they are required to disclose. Lenders and banks ask one hard question: can this business repay the loan and service the interest on time? Government in South Africa, primarily the South African Revenue Service, uses the information to determine registration status and tax liability, income tax, value added tax, employees tax. Suppliers want to know whether you can pay for what they deliver on credit. Their decision is not whether to invest in you, it is whether to trust you for 30 days. An investment analyst assess risk and return on behalf of people considering putting money in. One caution before the checkpoint. This list is not exhaustive. Trade unions, industry associations, insurers, and local authorities all use accounting information as well. What you should carry away is not the list itself, but the method. Identify where the users stand relative to the organization. Then work out what decision they are trying to make. The decision tells you what information they need. That brings us to checkpoint two. A wholesale supplier is deciding whether to let your business buy inventory on credit. Is that supplier an internal user or an external user? And precisely what information are they looking for? Closure and be specific. Financial information is not an acceptable answer. So information has uses, but not all information is useful. The framework gives us qualitative characteristics, qualities information must possess before it can be relied on, two fundamental characteristics on the slide, four enhancing ones on the next. Fundamental means non-negotiable. If information fails these two, no amount of polish rescues it. The first is relevance. Information is relevant if it is capable of influencing the economic decisions of users. Test it that way. If this figure had been different, would anybody have decided differently? If the answer is no, the information is not relevant. And reporting it merely adds noise. Banqueting venue costs are highly relevant when the board is deciding whether to open a second function room. Those same costs are irrelevant to a decision about outsourcing the laundry. The second is faithful representation. Information must represent what actually happened. Three tests sit underneath it. It must be complete with nothing material left out. It must be neutral with no bias, no shading of the numbers to flatter a manager or reassure a bank, and it must be free from error. Not perfect to the last cent, but free from mistakes in the process and free from misleading description. Room revenue reported must match actual guest night. No overstated occupancy, no timing games at year end. Hold these two apart in your mind because assessment love to test the difference. Relevance asks, does this matter to the decision? Faithful representation asks, is this true? And notice the tension between them. The most decision relevant information is often the least verifiable. Next season's projected occupancy, for instance, the most faithful represented information is usually historical, and history is not always what the decision needs. Managing that trade off is a large part of professional judgment in accounting. One more word on neutrality. Because it is often misread, neutral does not mean cautious. Deliberately, deliberately understating your asset to look prudent is just as much a distortion as overstating them to look successful. Neutral means the information is not slanted in any direction at all. The four enhancing characteristics do not make bad information good. They make good information better and easier to use. Think of them as polish on a surface that must already be sound. Comparability. Users must be able to compare this information with other businesses and with the same business in earlier periods. That is how trends become visible. Cost per available room this year against last year. Your lodge against a competing lodge of similar size. Comparability is the reason we insist on consistent accounting policies from one year to the next. Change your method every year, and your own history becomes unreadable. Understandability. Information must be readily understandable by its users. Note carefully what this does not mean. It does not mean simplifying until complex transactions are misrepresented. It means presenting information clearly, classifying it sensibly, and assuming a user with reasonable business knowledge who is willing to study it, a front end office manager without an accounting degree should be able to read the monthly departmental report and know how that department performed. Timeliness. Information must be available while it can still influence a decision. Old information loses relevance and eventually loses all value. Publishing March result in April lets you correct course in May. Publishing March result in September means you have simply documented a problem you can no longer fix. Verifiability. Different knowledgeable and independent observers working from the same data and the same assumptions should arrive at the same result. It is reproducible, which is what makes it auditable. A food and beverage stock count can be reperformed by an auditor and it should produce the same figure. Note that these four are applied together and none of them outranks another. You should not trade timeliness away for perfect verifiability or sacrifice parability to make a report easier to read. You aim for all four, and where they pull against one another, you exercise judgment. One consistent sits over all six characteristics: cost against benefit. The benefit derived from producing accounting information must always outweigh the cost of producing it. A small guest house does not need the reporting infrastructure of a listed hotel group, and building it would be poor management, not good accounting. Now we move from information to structure. The legal form a business takes determines its risk, its access to capital, its continuity, and its tax treatment. In South Africa, we work with four basic forms. Let us read the table together because the differences down each row are exactly what you will be assessed on. First, the sole trader, one owner, a guest house owner, a private caterer, a freelance consultant. The owner supplies the capital. And apart from a trade license and any industry requirement, there are no legal formalities. Now look at the liability row: unlimited personal liability. The business is not a separate legal person. So there is no wall between the business and the owner. If the business cannot pay its debts, creditors may claim against the owner's house and car. Continuity: the business ceases on the owner's death or retirement. It cannot outlive its owner because in law it is its owner. Second, the partnership: a legal relationship between 2 and 20 people carrying on business together for profit. Two chefs opening a restaurant, that's a partnership. New partners bring additional capital, new ideas, and specialization. One runs the kitchen, another runs front of house and finance, but look at the liability row again. joint and several unlimited liability. Read that phrase precisely. Joint and several means a creditor may pursue any one partner for the whole debt, not merely for that partner's share. If your co partner cannot pay, you pay all of it. Like the sole trader, the partnership is not a separate legal entity and it ends when a partner exits or dies. Third, the close cooperation between 1 and 10 members who must be natural persons. Here, the liability rule changes. Limited liability. The close corporation is a separate juristic person. It can sue and be sued in its own name, and it enjoys perpetual succession, which means it continues regardless of who comes and goes. It is taxed in its own hands at company rates. Fourth, the company, one or more shareholders, private or public, again, a separate legal entity, again, limited liability, again, perpetual succession. Shareholders are not liable for the company's debts beyond what they have invested. The private company's name and in proprietary limited, and it may not offer its shares to the public. The public company's name and in limited. It may issue shares to the public through an initial public offering, and those shares trade on an open market such as the Johannesburg Stock Exchange. Companies are registered with the Companies and Intellectual Property Commission and governed by the Companies Act of 28, rather 2008. Checkpoint 3. You and a friend want to start a business together and you want certainty that if the business fails, your personal house and car cannot be taken to settle its debts. Which form in this table protect you and which do not? Pose and answer, and then explain why the ones that protect you are able to do so. One important qualification on close corporations, and it is the kind of detail that separates a distinction from a pass. The Close Corporations Act of 1984 created the close corporation as a form unique to South Africa. It was designed for smaller businesses that wanted limited liability without the administrative burden of a company. It worked well, and many are still trading today. But when the Companies Act of 2008 came into operation in May 2011, registration of the closed corporations stopped. You cannot register one now. Existing closed corporations may continue to operate indefinitely, and their members may convert them into companies if they choose to. So when you are asked to advise a client on choosing a business form today, the closed corporation is not on the menu. It remains examinable because you will meet existing closed corporations throughout your career as clients, as suppliers, and as competitors. And you need to understand how they behave. Practical effect of the 2008 Act was to simplify company registration to the point where the closed corporation was no longer needed. Private company took over its role, and it now offers the same limited liability and the same perpetual succession without the 10-member ceiling that constrained a growing close corporation. Something worth repeating: one or more shareholders, private or public. Again, a separate legal entity. Again, limited liability. Again, perpetual succession. Shareholders are not liable for the company's debts beyond what they have invested. A private company's name ends in prior, proprietary limited, and it may not offer its shares to the public. A public company's name ends in limited. It may issue shares to the public through an initial public offering, and those shares trade on an open market such as the Johannesburg Stock Exchange. Companies are registered with the Companies and Intellectual Property Commission and governed by the Companies Act of 2008. The business form tells you the legal skeleton. The type of business activity tells you what the organization actually does, and that determines how complex its accounting will be. There are four types: service, manufacturing, wholesale, and retail. A service business provides a service and charges a fee. That income is called fee income. Plumbers, architects, and attorneys sit here, and so do hotels, guest houses, restaurants, conference venues, and travel agencies. Notice what a pure service business does not have. It does not buy goods in order to resell them. So it carries no trading stock, which makes its accounting the simplest of the four. A manufacturer buys raw materials and physically transforms them into a finished product. And raw materials are not always raw in the everyday sense. A bakery's flour has already been processed by a mill. A hotel kitchen is genuinely a manufacturing operation. It converts ingredients into plated dishes. That transformation is why manufacturers must track three kinds of stock: raw materials, work in process or work in progress, and finished goods. A wholesaler is the middleman. Wholesalers buy in bulk from the manufacturer and supply goods in smaller quantities to the retailer. The food service distributors and beverage wholesalers who deliver to hotels and restaurants sit here. A retailer buys goods from wholesalers or manufacturers and sells them to the general public at a markup. Cost price plus markup gives selling price, a relationship you will calculate many times in later unit. Retailers bring goods within reach of the consumer, sell in small quantities rather than in bulk cases, sometimes allow credit and offer convenience. The curio shop and the minibar in a hotel or retail operations. Why does this classification matter to an accounting student? Because it determines what you will have to record. Trading stock, cost of sales, and markup calculations only arise once goods are being bought and sold, which is why the wholesale and retail models drive so much of the work in later units. And here is the point of the matter. One organization usually contains several of these at once. A single hotel runs a service business in rooms, a manufacturing operation in the kitchen, and a retail operation in the gift shop. That is precisely why departmental reporting exists. Last piece of the map is the field of accounting. Accounting has to serve two very different objectives, and two distinct branches grew up to serve them. Accounting reports to external users. Everything about it follows from that one fact. Those outsiders cannot demand extra information, and because they need to compare one business against another, financial accounting is governed by strict rules, international financial reporting standards issued by the International Accounting Standards Board. Those outsiders need reliability more than they need speed. It is historical. It reports what has already happened. And because outsiders are interested in the entity as an investment or as a credit risk, it summarizes the business as a whole in standard set of statement at fixed intervals, usually once a year. Management accounting, sometimes called cost accounting, reports to internal users. Again, everything follows from that because management can ask for whatever it needs. There is no prescribed format and no external standard. Because management is deciding what to do next, it is future focused. Budgets, forecast, projections, break even analysis. Because managers run specific parts of the business, it isolates those parts, the rooms division separately from food and beverage, the center property separately from the Durban one. And because decisions cannot wait for your end, it is produced as often as it is useful, which in the case of an occupancy and a revenue report means daily. Let me put contrast into one sentence because this comparison appears in assessment year after year. Financial accounting is historical, regulated, external, and reports on the whole entity. Management accounting is forward looking, unregulated, internal, and reports on the parts. Here is the distinction in practice. The question, how did this hotel perform last financial year, is a financial accounting question. And the bank and the revenue authority will ask it. The question, should we close the restaurant on Mondays next winter, is a management accounting question. And only the internal team will ever see the answer. Neither one is more important than the other. They answer different questions for different audiences, and both draw on exactly the same underlying transactions. Two further fields complete the picture: tax and auditing. Tax is about compliance and planning. Compliance means the returns and filings that must be made correctly and on time. Income tax, value added tax, employees tax. Planning means structuring future transactions lawfully so that the tax burden is not heavier than it needs to be. Note the distinction between planning and evasion. Tax planning arranges your affairs within the law. Complete the picture: tax and auditing. Tax is about compliance and planning. Compliance means the returns and filings that must be made correctly and on time. Income tax, value added tax, employees tax. Planning means structuring future transactions lawfully so that the tax burden is not heavier than it needs to be. Note the distinction between planning and evasion. Tax planning arranges your affairs within the law. Tax evasion misrepresents them, and it is a criminal offense. Auditing examines whether things are what they claim to be, and it comes in two forms. Internal auditing. Internal auditing looks at the organization's own systems and transactions to establish whether they operate as intended, free from weakness, fraud, waste, and mismanagement. Internal auditors are employed by the organization and report to its board and its audit committee. Their focus point inward: are our controls actually working? External auditing is performed by an independent auditor from outside the organization. And be careful with the wording here because it is frequently examined. The external auditor does not certify that financial statements are correct in every detail. The auditor expresses an opinion on whether the statement fairly presents the financial position and performance of the entity in accordance with the applicable framework. Independence is what gives that opinion its value. And auditor who depend on a client's goodwill as nothing worth selling. Both a form of auditing rest on the same idea. Somebody independent of a person who prepared the information should test it before it is relied on. Put simply, financial accounting produces the statement, management accounting produces the decisions, it handles the obligation to the state, and auditing provides the assurance that the first of those is being believed. Now, and most of what you have mapped in the session. The what? Counting is a communication system with 5 steps: gathering, analyzing, recording, reporting, and interpreting, producing financial and non financial information for decision making. The who? Internal users inside the organization, external users outside it, each asking different questions of the same underlying data. But how? Information must be relevant and faithfully represented before anything else. And then comparable, understandable, timely, and verifiable. And the business form chosen: sole trader, partnership, close corporation, or company, sets the limits on liability, continuity, access to capital, and tax treatment. The where: service, manufacturing, wholesale, and retail activity served by financial accounting, management accounting, tax, and auditing. Everything in the learning unit that follows sits on top of this. When we build the accounting equation, remember that it is a device for recording. When we work through the accounting cycle, remember that recording exists to support reporting. That reporting exists to support interpretation. And that interpretation exists so that somebody can decide something. And if you remember nothing else from this session, remember the chain that holds it all together. Somebody needs to make a decision. The decision requires information. The information must be useful, which means relevant and faithfully represented. Producing it requires a system. That is counting. The roots first, then the tree. One final task before we close the session. I want it written down, not merely thought about. Imagine a sole trader who runs a service business. First, give a concrete example of that specific combination, not a category, an actual business. Name it. Say what it does and say where its fee income comes from. Second, name one major limitation that owner faces because of the business form they have chosen and explain what that limitation means for the way the business is able to grow. Bring your answer to the next contact session and be ready to defend it. If you can do that, you have understood Learning Unit 1 and you are ready for Learning Unit 2, where we build the vocabulary of accounting: asset, liability, equity, income, and expenses. Thank you for your attention.